Welcome to Resilient in Business, a podcast where we dive into insights, strategies, and systems to help you build scalable, thriving businesses. My name is Jad Atwe. I'm an engineer, an entrepreneur, and a business coach. Our intention from this show is to provide value and inspire entrepreneurs to keep pushing forward no matter the challenges. If you enjoy the content, subscribe and help us spread the message. Now, let's get into today's episode. Today's topic is financial forecasting and understanding our data in order to make better and more strategic decisions. For this, I'm joined with John Scott. John is a partner at Anders CPAs Advisors, where he's been working in this field for 30 years and has a lot of valuable insights. This is going to be a very interesting episode. Thank you for joining us, John.
Thank you. Thank you for having me.
John, if we want to be honest, accounting isn't necessarily everyone's passion. Every business owner's passion. What got you excited about it? How did your career evolve? And was there any moment along the way where you thought that I had enough of this?
You know, you're right. Numbers are not everyone's passion, but accounting is not really all about numbers. It's about helping people solve problems. And, I joined Anders in 1992, and it's a large local firm, one office, city of St. Louis, Missouri. And most of our referrals came from attorneys, and they were feeding us work. We loved those referrals because the attorney's fees per hour were generally higher than ours. So if you're willing to pay those fees, then it's good for us. Early in my career, I met a very entrepreneurial attorney who he obviously read the E-Myth books, and he decided he wanted to work on his business rather than in it. And he taught me over 17 years in our relationship how to run a business based on data and make decisions based on data. He didn't want to be the practicing attorney with no leverage. He wanted to be the business owner who ran a successful law firm with tons of leverage, and that he could sit back and manage and work on his business. So over those 17 years, I watched him. He made mistakes, but because he was paying attention to good data, he could course correct pretty quickly.
Yeah, so what's your involvement like and how are you supporting them?
Well, when we get involved with business owners, we want them to have what we call profit-focused accounting, and it's really foundational. How much cash do you need to run your business so that you're not making decisions in a reactive manner, but rather proactive? And then how much production, what are the revenue drivers that drive profit and cash flow? And then, of course, your financials and your capacity or your pipeline. And once you can pull together those four areas of profit-focused accounting, you can make good decisions and focus on the future rather than focusing on the past. And too many accountants are historical in nature. Your grandfather's accountant told you what happened, but wasn't really involved in telling you what's going to happen. And that's what CAS 2.0 and client advisory services aims to do, is change the way people think about the accounting profession.
Yeah. What's the process? What's the right approach to this? Are we starting by looking at what happened last year and then trying to forecast from that point? Or what process do you guys follow in order to make sure that the information is accurate and those firms are on track?
Right. We dig in, and it takes us about 8 to 10 weeks to get things caught up, to look at the procedures that clients go through on a monthly basis, to offer suggestions for best practices. And we really want to simplify things. We want to simplify data entry and use automation to help free up the time of people internally and our time so that we can focus on those higher level things. And once we get the foundational piece in place, then we can build out KPIs and forecast. And what we use is a maturity model. And the maturity model it's an assessment that companies can take. We take it along with them. We suggest a score in the 5 different areas of the maturity model, and then align it with their expectations and what they think. And the score is 1 to 5 in each of these 5 areas. Many people are in the 2 to 3 area. And ideally, let's say you want to sell your business. Somebody's going to pay a premium for a business that has got high marks in all 5 areas of the maturity model. They're going to pay a premium for that business. But if your records are poor, if your processes are not good and efficient, they're going to buy that company at a discount. So whatever your goals are, moving up that maturity model is what we help clients do so that they can achieve their goals and know where they're going.
So let's talk about the different areas in this model. What are they?
They first and foremost look at your cash position and the processes in which you reconcile and record cash. And, many people don't value the finance function. They're a starting business and their niece's neighbor does some QuickBooks on the side. It's not their priority. They're not getting highly compensated for it. And so they're 2 or 3 months behind. You can't run a business that way. And so we have to value the process and invest in getting good information so that we can make those decisions.
Cash is one aspect. What are the other aspects?
Cash financial is the second area that we focus on, and that is just having good financial information on the accrual basis. Now, there's a lot of consultants out there, and I don't disagree with them. They bash gap accounting. They like full on accrual accounting. I don't necessarily disagree, but I do think that you have to follow some sort of modified accrual basis accounting. You have to know where you are, because think about a professional service firm that does all this work in the fall of one year and the winter, and they get paid for it next year. If we just took cash basis accounting as it stands, we'd have a loss in the first year and a big gain with all the expense associated with it in the prior year and the second year. When in reality, we need to know on the accrual basis, we need to match up that revenue and expense. That doesn't mean in the US we're going to pay tax on the accrual basis, but I want to run my financial statements on a modified accrual basis to record work in process, inventory if it exists, accounts payable, to match up the income and expenses to get a true picture of where we're going. Because what I can tell you is if my accrual basis financial statements are growing, I've got bigger AR, bigger inventory, bigger work in process, then my cash will follow. I'm going to have more cash, net income, and profit going forward. If they're declining, then my cash is going to decline in the future as well.
Hey, a quick commercial break. This podcast is brought to you by Business Optimization Partners, a firm that specializes in helping entrepreneurs systemize their business and transform it into a professionally managed asset that is scalable and easy to operate. If you wish to learn more, download the guide to running a professionally managed business that's available in the description. Now, back to the episode. Yeah, there's different variables you have to look at to assess the big picture, I guess. Step back and understand what's going on.
Right. Another area that we like to focus on is the pipeline of a company. So you need to judge your capacity first. If I have no capacity to take on new work without adding new people or new machines, then I can't be very aggressive with looking for new work. But if I do have capacity and I know what that capacity is, then I can go and look at my pipeline of work. Where does it come from? What are my prospects? And what is my close rate on converting those prospects to being new clients or then I can say, if I close 50% of all my opportunities and my capacity is $200,000 worth of work, I need a pipeline of $400,000 to fill that capacity. Now, nobody's going to have 100% filled capacity all the time. But if you think about if you've ever done any work on your home, let's say you want to remodel a kitchen, and you get 3 bids from contractors, 2 of which are really stiff and strong bids, and the other one is more aggressive and it's lower priced. If you look under the hood, I would bet you that 2 of those contractors are near capacity. And the other one, assuming he's a good contractor or she's a good contractor, might have some capacity and they want to keep their people busy during the slow time. And so they're going to be a little more aggressive on pricing. And that's kind of the capacity planning that you can do when you know the details of your pipeline and what your capacity actually is.
Yeah. So based on that, your clients are able to adjust their pricing. Is this part of based on like seasonality, based on what's happening down the line? Is this what you're advising on?
Right. It's one of the levers that you can pull if you've got the mythical widget machines in on the factory floor and they're idle. Well, then let's get them busy. I don't want to lose money every widget I make, but I want to keep them busy because when they're idle, I am losing money. Same thing goes for professional staff that are sitting out in the chairs. And we look at things a couple of different ways. We like to look at gross margin per professional, but we look at the standard bill rate that we're charging for each of those individuals, which is what we tell the world we charge per hour. And then we look at an average bill rate, which is what we actually write the bill up or down to when we send the bill out to the client. And then ultimately, we want to look at the effective bill rate, which is what we're paying them for every hour that they're sitting in their seat. Because I know what my costs are, but now I need to know what am I paying them for not only billable work, but non-billable work. And if I can beat that, if that's a higher rate than my cost, then I know that I'm making money.
Absolutely. It's a profit first methodology, I guess. This what
Exactly.
you're, yeah. After pipeline, what are the two remaining items?
It's cash, production, financials, and pipeline. So production is the other area in which we can pull certain levers. We can raise our hourly rate per hour. That doesn't mean that we'll capture it all, but in reality, we have expected utilization or expected charge time from either the machine on the factory floor or the person that's out here doing the work for the clients. We may expect 30 hours a week chargeable from our professional staff, but we might go to them and say, hey, can you give us 2 more hours a week? And that doesn't seem that impactful. But if we couple that with 2 more hours times 100 people times 50 weeks in the year, it becomes very significant without any additional cost. And many times clients will say, and we're in this time where hopefully the pendulum is swinging a little bit, where staff are getting recruited away for more money to go somewhere else and better quality of life. We can give them that better quality of life, additional PTO. And the trade off is, hey, give us 2 extra hours a week for 50 weeks. That's 100 hours. And we'll give you an extra week of PTO. Everybody wins in that scenario. So those are just some levers that you can pull in the production area that will help keep and retain staff and increase your profit and cash flow.
Yeah. This is basically forming a deep understanding to your numbers, to what's happening in order to make those decisions.
Exactly.
Yeah. So what do you say, like, when you're helping with forecasting projections, how often do you recommend people go back and review those projections?
At least every month. And so many times people budget in the fall for the next year, they put it away, they might look at it 2 or 3 times in the year. But I liken this to, I don't know if you ever took a trip using a physical map, okay? But the map told you where the highways were, right? My grandpa had an atlas that was about 15 years old, and he would write down notes and then off he would go. And he had to react to whatever happened. You know, there was construction on the highway. Well, that 15-year-old map didn't anticipate that. Today, we have the Waze app and GPSs that can tell you, hey, 2 miles ahead, there's construction, and here's a workaround. So when we use a dynamic forecast, unlike a budget, and we're constantly evaluating our progress along that path to our journey, we can course correct. We can still meet or exceed our goals by those decisions we make based on the current data to get where we want to go. Whereas, grandpa was just stuck with the old map and he saw the construction and he turned off the highway and he had no idea where he was going at that point. He got there, but he couldn't meet or exceed his goal to get to his destination because he was in a reactive mode rather than proactively paying attention and course correcting your forecast.
So are you setting those businesses up with software that helps them monitor this process, or is it Excel spreadsheets?
It's a combination. We are extracting information from their accounting system and putting it into our proprietary systems. We develop these things using reach reports. We give them access to the forecast and the financials and the KPIs, but then we're not trying to recreate the wheel and repopulate an Excel spreadsheet all the time. We want this to be as automated as possible once we get it set up, and then they can go in and look at it. We can look at it with them on a monthly basis and help them make decisions based on the data.
Yeah. What size of business do you feel is best suited for this process? Because it sounds like there's a lot of information required in order to go through it.
I think the size of the business is smaller to mid-size, but more importantly, it's a company or firm that wants to grow. Now, we do VCFO services, not just for the legal firm clients, but also for digital ad agencies, construction and real estate companies, trucking firms. It doesn't matter the business. What matters is, can we identify the revenue drivers? Do they want to grow and scale? Do they not do they need the financial talent, but can they not afford it yet? So we can provide it on a subscription basis. So the value proposition is, we're giving you a VCFO, a controller, a technology person, and a staff accountant on a fractional basis. And we're able to do that a lot more efficiently than if you hired two or three of those people in your firm. And think about it, if you hire those in your firm or your company, you're taking a big risk that you're hiring the right person. So our subscription model has no long-term commitment. You basically are hiring us. We come in, it takes about 8 to 10 weeks to get you onboarded, and then off we go. If you want to change services along the way, we just issue a new statement of work. You want to add payroll, take payroll off, the fee changes, and we go forward.
What are the things that you see business owners get wrong, or maybe they don't have a proper understanding of?
Not valuing their financials and their current cash position, not having current reconciliations of your credit cards, cash accounts done so that you don't know where you stand at every moment. I mean, in reality, it's not that hard to reconcile cash, even on a daily basis. So knowing and having good information to make proactive decisions is the best thing that a business owner can do. It allows them in a proactive environment to make investment decisions with the cash that they have. And if they don't have the cash that they need, then it allows them to set a plan to get to that position of having the cash they need to run their business.
Do you have some case studies of a successful business owner, and what was the result?
Okay. The first law firm that we picked up was struggling with cash. They didn't have enough cash on hand. They had a great staff of 10 attorneys, two partners, and they couldn't understand why they didn't have the cash in the bank that they needed. And when we quickly got in there, we noticed that no one, including the two partners, were charging enough time to client work. There was plenty of work there, plenty of work for them to do, but especially the two partners, their hair was on fire and they couldn't figure out what was going on. So rather than serving clients and managing their people, they were going at each other a little bit saying, well, here's the problem. Here's the problem. They didn't know what the problem was. And when we identified that no one, including them, were serving clients, it took about 45 days for the cash to start coming in the door. And that really helped the situation. Another example is many firms have payable systems that are outdated. Things get lost, bills get lost. And then the human element of entering those into the accounting software and the error problems that occur with that can be fixed by automating that, by going to like a bill.com where you train your vendors to email bills. They're automatically coded into your system based on what they were before. Yes, there can be modifications. An email goes to the appropriate person in the organization to approve the check, or an ACH is cut, and boom, it's sent off. So it's better for the vendor, it's better for the company, and it streamlines the whole process. You get good current information without the human element and potential human error, and it frees up time internally. It helps the owner, the decision maker, to have better oversight over the process, and they're getting better information.
I'd imagine this process doesn't take a lot of time from the business owner's time after you set it up. It's mainly just, oh, here are the receipts, here are the new revenue that comes in, it goes into the software, and that's it.
Yeah, we do need some face time with the owners. We want to go over the financials at least once a month and any other issues that come up with capacity planning or their cash needs. And really, the heavy lift is done by someone in their organization who's already handling some of the finances. So we're going to work with them to make the processes better, make their life easier. But we do need time with, different people within the firm, but the ownership group at a minimum once a month, at least an hour to go over financials and any other issues that come up.
How long do you see it takes to turn a business around from not being profitable to making money or being at least on the right track?
Well, if it's a function of they've got, a good pipeline of work, they're just not executing on it, that doesn't take that long. If it's a function of I don't have any clients, that's a bigger lift. Most places have a good business, they're just not paying enough attention to the financial part of it. And once we can get them caught up on the finances and train their people just to be more efficient in their processes with regard to the finances, that would just be a few months.
Thank you, John. This was very insightful. There's a lot here to unpack. I mean, reflecting on myself here, finance, the financial part of the business sometimes gets ignored because we're focusing more on doing stuff, on operations, on getting new clients. And the problem here is that once you want to file taxes, this is when you feel it.
Right.
Yeah.
Hey, I do want to plug a book I wrote. It's called
Tell me.
Judicial Dollars and Cents. It's modeled after a book that my partner Jody Grundon wrote, which was Digital Dollars and Cents. Mine deals with law firms, his deals with digital ad agencies, and I'll send information on that for the show notes.
Absolutely. And what's your final advice, final words of wisdom? How can people reach out as well?
You can reach me on LinkedIn at John C. Scott CPA. I'm with Anders. And the final advice would be learn to work on your business rather than in it so that you can create this business. One, it can be a lifestyle business that others work and you benefit from. But two, there's an exit strategy for every business. It could be you die, you become disabled. Ultimately, you want to sell or transfer your business. If you transfer the business internally, you're probably going to do that at a discount, either to a family member or to people who were working with you along the way to build it. If you want to sell it externally, cleaner your financial records are, the bigger premium you're going to get for that business.
Thank you, John. Thank you.
Thank you.
Thanks for tuning into the Resilient in Business podcast. This show is all about providing valuable insights and inspiring entrepreneurs to keep pushing forward no matter the challenges. If you enjoyed this episode, be sure to subscribe and help us spread the message. See you on the next one.